Let's talk about the markets and the economy in light of Friday's jobs numbers and with inflation upon us this week. Joining us now is Carey, Bank of America's Global Research Head of Small and Mid-Cap Strategy. Welcome to you.
Thanks for having me.
Although when you're small and mid-cap strategy, do you get bogged down with the macro or are you top down or are you bottoms up? I mean, what do you think is more informative right now?
Both. I mean, I think, we're fundamentally seeing a good backdrop with earnings season. Earnings are coming in better than expectations kind of across the cap spectrum right now. Guidance has been much better than expected. And then on the macro, I mean, our economists at BofA just revised up their economic outlook, so they're no longer expecting a recession this year.
So would you say, just out of curiosity, I'm not trying to start some infirm drama, but were you guys more constructive on the outlook for earnings? You know what I mean? Like when you looked at the companies, did you worry a big slowdown was coming? Or it feels like the macro has had to catch up to what's happening on the company level.
Well, we were expecting initially, a more negative earnings backdrop and revised that up as well. I mean, the earnings backdrop, we're still expecting roughly flattish growth this year, better growth next year. But I think, now that we're expecting a soft landing, a lot of the segments of the market that have been pricing in a recession, and there are pockets of them, small caps being one of them, we think are poised for, at least near term, somewhat of a rebound. And, I think the fact that we could be shifting from more of this downturn backdrop to early cycle in terms of a regime is typically positive for cyclicals and smaller stocks.
I was just looking at apparently some of the like cardboard corrugated box, like these kinds of earnings have been coming in and they're seeing a little bit of a turn, and people think then the ISMs are going to follow and then we're going to be off to the races. Just real quickly, you mentioned that small caps are priced for a recession. What tells you that? Because the other stat that gets thrown around is 40% of the Russell 2000 is not profitable. So what are you watching there that kind of shows that?
Right. I mean, I think, near term, when you look at positioning, multi-cap managers, their weights in small cap stocks is at record lows. Flows have been extremely negative this year. You're starting to see a little bit of a turn there. Valuations are extremely cheap relative to large caps, near historic lows. And usually valuation tends to be a good longer-term predictor as well. So if, you're thinking about large versus small over the next decade even, it could be a good time to own small. But I do think, to your point, medium term, once you see this, catch-up rally, then it makes sense to be more nimble and selective and cautious in small caps, given some of the refinancing risks, given some of the, the fact that a third of the index is non-earners that aren't profitable.
Which is always true, right? I don't think that's is that a new factor? Is that always the case?
Well, it tends to spike up, obviously, during, downturn periods, but it is more elevated than normal in part due to, bigger weights in biotech and healthcare and following the IPO boom. So, within small caps, we would actually be more cautious on, healthcare and tech relative to in large versus in some of the other, cyclical sectors that look a bit better.
And I mean, certainly if you look at like the small cap 600, the S&P small cap, it's, got a profitability screen. There's a similar valuation gap with large cap, right? I mean, it still seems like it's at a pretty significant discount. I guess the question is, if I look back to the early 2000s example of when you really small caps did kind of protect you in that bear market, and going beyond that, do we need to have the mega caps break to kind of create some kind of a mean reversion here?
Well, I think, we're at the point where we saw significant mega cap leadership, and now we really just expect, a broadening out of the market. So we like the equal weighted S&P 500 over the cap weighted S&P 500. We expect some catch up from small caps. Usually, we're in a new bull market. Usually when you're in a new bull market, small caps lead by a significant margin, and they've actually lagged large caps since the lows last fall. So, definitely room for catch up here. But we are watching, goods versus services. Small caps are more exposed to services. You're starting to see a little bit of a goods comeback, potentially seeing if that's going to be at the expense of services. So, I think lots of room for a catch-up rally right now, but makes sense to be nimble, makes sense to pick stocks over just, simply buying an index. S&P 600, as you mentioned, is a bit higher quality in terms of an index.
All right. So then if we have no recession, but we're still priced for recession in the Russell 2000. July was a good month for the Russell, or was it not?
Yeah, I mean, I think you've seen a bit of a comeback recently, after a pretty poor first half. And I think, you've seen sort of this weird dynamic in small caps where you actually have kind of seen risk on. I don't necessarily expect, the low quality, biotech and mid cap softwares to persist in leadership. Certainly you can have these short-term rallies in those areas.
So the meme stocks, the unprofitable biotechs, it's like, that does tell you that risk appetite is back, I guess.
Right, yeah. A lot of the low-quality stocks have been what's led this year. But I think, like I said, when you're in an environment where rates are, could be higher and inflation could be more elevated for longer, rates and credit spreads, could go back up if we see a tightening of credit conditions. All of these are risks to small caps that have a lot of short-term and floating rate debt. So, I think as you look out the next couple of years, they're going to hit a lot of maturity walls. So there are, certainly pockets of small caps that are going to be at a lot more risk for that. So I think having, leverage screens on your investment process definitely makes sense. Leverage as a factor will matter more than it has historically.